Welcome to TheoTrade. This is Don Kaufman. It's Monday, February 12th, 2018. We've got about an hour left in the trading session with the S&P futures up about 43 points. Nasdaq futures flying to the upside, up 120. But I will point out one interesting aspect of today's rally. If you take a look at the volatility futures. Now, why do I look at the volatility futures, not the VIX? Because the volatility futures, that's about skin in the game. People are buying and selling them. And you take a look, they're actually flat on the trading session, which at that point you have to entertain the idea that anything is possible moving forward. Now, given some of the volatility that we've seen over the last few trading sessions, I think the time is better spent on this evening's video pointing out a couple of aspects that you need to be aware of to survive volatility. Let's actually get started. Even put together a couple of slides for this. Number one, liquidity matters. So in just real brief terms over here, you got to trade liquid markets. Everybody's aware of that. But one of the issues is that when the market, the volatility kind of quote unquote hits the fan, liquidity tends to concentrate into a limited number of products. And again, during episodes of intense volatility, the concentration of liquidity piles into literally only a handful of products. And you guys will probably agree with that. If you try to get filled on a trade either last Monday or last Thursday, the only place that was getting it done was possibly the S&P futures. There were a lot of products that were next to impossible to trade. The bid-offer spreads are going to widen out, even in the most liquid of products. And you always have to keep this in mind, because this is an area that a lot of people don't necessarily think about, but whatever trade you have on, you may not be able to get out when you absolutely need to get out, which kind of means never place yourself in the position of needing to get out of anything. And yes, I'm talking to you, you iron condor sellers that get yourself buried in huge risk. The market starts tanking like it's on fire and your trade is not getting filled. So liquidity matters. Take it seriously. And remind yourself, I might not necessarily be able to get out of this position, and that could have devastating effects. And if that's the case, you either have to figure out a way to hedge the risk, okay, or just don't take enough risk to ultimately put yourself at that kind of exposure. Next, size matters. If you're used to trading, and most people here, if they've been trading a couple of years, you haven't traded in a heavy volatility climate. Now, again, if you're used to trading in something like an 11 VIX, what's the first thing you should consider when volatility spikes? Now, bear with me here for a moment. We'll cruise over to the marketplace and you take a look at the VIX. And I'm just using the VIX right now. And, listen, the VIX is the VIX. The S&P 500 volatility index, okay, it's at 25. But if you look back here over the last 3 years, and many of you, you've traded a couple of years, especially if you intraday traders, you may never have experienced sustained degrees of volatility. Right now, we've got a VIX sitting back at 25. And last time we had sustained volatility at that level, you got to go back to what amounted to a very serious sell-off. Again, this is early 2016. Now, the reason I bring that up is the higher the VIX, okay, it directly implies, higher volatility directly implies you're getting more movement in individual stocks or your overall market. The bright side is this. You get a lot more bang for your buck. Cut your trading size in accordance with the increased movement in the markets. You think about it, like if volatility doubles, you can literally half your trading size and still maintain the same profit and loss swings. Right? And that's one aspect. We had volatility go from the 10 handle up to 40. Contract last week was cruising around the 30 level. Okay, it's contracted a little bit. But again, have you cut your trading size in half? Because if you haven't, you're in a little bit of dire straits out there. Now, another aspect when I talk about, trading and size over here is kind of the deer in the headlights. Listen, it's about indecision. Volatility breeds indecision in retail clients. I spent 15 years in the brokerage industry, and every time markets get volatile, it's literally people don't even do anything in some of the heaviest volatility. They just sit there and watch the screen and they go, I'm going down. Well, the reality if you ever have that indecision, at least, okay, cut off maybe half the position. You don't have to do all or none. Should I get in? Should I get out? Should I get in? Should I get out? Indecision will crush you in this business. Okay, if you have it, cut half. Why? Because if we rally back up, you're beautiful. We sell back off, you're like, good thing I took off half. Okay, I'm not just talking about having your trading size. I'm saying when you have indecision on an existing position, it's okay taking off portions of your position. It doesn't have to be an all or none kind of world. Next, Volatility Crush. Now, this is one where, after a lot of years of doing this, it also kind of drives me a little bit crazy. In the midst of volatility, you may be so inclined as to want to purchase a call option thinking the market may rally. Ironically, that's today. The markets may indeed rally. However, you're not going to probably profit on there because the volatility is going to get crushed. Interesting, though, today is the market's rallying, but volatility is really not going down that much today. However, okay, in a real rip-your-face-off rally, if you've never heard that term, you haven't traded long enough, but a real rip-your-face-off rally, the volatility is going to get crushed. As the markets rally, well, vol gets crushed, especially after large down moves. Buying calls, right? Like, listen, everybody sees the market's coming down. They buy a call down here. The market bounces, but you know what? Volatility gets crushed at the exact same time, and it takes their hopes and dreams along with it. Buying at the money or out of the money calls is a serious mistake. It'll leave you exposed. It's beyond exposure. It's, for the most part, that's how, people get just disenchanted with options. Significant volatility risk in buying calls after a down move. If you're intent on buying options, you're going to probably have to use an 80 delta or higher to avoid the volatility crush. Don't get vol crushed. You've been warned. And if you don't like buying an 80 delta option to avoid the vol crush, here, when we're volatile, use vertical spreads to mitigate vol risk. Spread your risk. Spread your risk. Why? Because spreads offset volatility risk. Okay, via buying volatility and selling volatility. If you are not aware of what I mean, okay, you go into a product like, hey, is Netflix volatile enough for you? Okay, Netflix, it moves. Okay, it absolutely moves. Today it's up some $7. And when I say is it volatile enough, do I need to go to the chart? Do I? Okay, Netflix is still stone's throw off its all-time high. But using spreads, and let me just show you what a spread is doing. Okay, we'll knock down the number of strikes in here. Take a look at something called Vega. Vega is an option sensitivity to changes in implied volatility. When you use a spread, what you're doing, for instance, if I bought these 255s and then I could turn around and sell the 260s against it, okay, what that's doing is with one stroke, you're buying the vol, the other stroke, you're actually selling the vol. And what it does is it counteracts the volatility completely. So the spread is neutralizing your Vega risk. Ironically, it's also neutralizing the theta risk of the position. These are aspects that you need to really adhere to. Okay, if this is something, in a video you want to refer to a couple times over the next few weeks to kind of keep yourself on the straight and narrow, then do so. Doesn't matter that we're rallying today. Doesn't matter that we're going to rally tomorrow. Volatility is here right now, and you have to make adjustments if you want to be able to survive this. Thanks, everybody. Have a wonderful evening. Bye-bye.